Hello and welcome. In the world of options, we spend so much time talking about buying calls, buying puts, betting on a big move. But every single trade has two sides. So today, we're going to flip the script. We're going to meet the person on the other side of that bet, the option seller. Let's dive in and find out who they are, and more importantly, why they do what they do.
So let's start with a really simple question. Think about it. When you pay a premium, say a few $100 for an option contract, that money doesn't just, vanish into thin air. It has to go somewhere. It goes to someone. But who?
And that someone, of course, is the option seller. This is the counterparty to every single option buyer out there. They're taking the exact opposite position, but with a completely different set of goals, risks, and yes, potential rewards. The whole transaction is actually surprisingly direct. Let's say you buy an option for $300. Well, as Kenneth Trester points out, that $300 goes right into the trading account of an unknown seller on the other side of the exchange. They're often called option writers because, in a way, they're creating this brand new contract and selling it to you.
Okay, this table really lays out the night and day difference between these two roles. The buyer, on one hand, pays a premium. In exchange, they get the right to make a trade later. The best part for them? Their risk is capped at whatever they paid for that premium, but their profit potential is theoretically unlimited. Now flip that completely on its head for the seller. The seller collects that premium, which is their big incentive, but in return, they accept an obligation to fulfill the trade. Their profit is strictly limited to that premium they collected, but their potential risk, well, it can be absolutely massive. So that leads to the million-dollar question, right? Why would anyone take on that kind of lopsided risk? The answer, my friends, comes down to the powerful, consistent allure of collecting that premium over and over again. Honestly, this is the best way to think about an option seller. They're basically running their own little insurance company. You, the buyer, are paying them for a policy that protects you against a huge swing in the stock price. The seller happily collects that payment, that premium, and is essentially betting that the catastrophe you're worried about won't actually happen. And if the stock just kind of chills out and doesn't do much, the policy expires worthless and they just keep your cash. And here's the kicker. The seller has a powerful, invisible ally working for them 24/7. It's called time itself. You'll hear traders call this theta, or time decay. All it means is that every single day that passes, an option loses a tiny bit of its value, assuming nothing else changes. For a buyer, this is a killer. It's a constant headwind. But for the seller, it's a beautiful tailwind, just slowly and steadily pushing profit into their account as the clock ticks down. But, and this is a big but, that consistent income does not come for free. Of course not. The whole reason sellers get paid is because they are willingly taking on these significant and, let's be honest, sometimes scary risks that buyers are paying to get rid of. This right here is the biggest danger, especially when we talk about selling naked options, which just means you don't own the underlying stock. If you sell a naked call and that stock suddenly shoots to the moon, well, a stock price can go up forever, which means your potential loss is literally infinite. On the other side, if you sell a naked put and the company goes bankrupt, you're obligated to buy a worthless stock at a much higher price. The loss is huge. This quote from Trester just hits the nail on the head. Because the risk is so massive compared to the small premium you get, you absolutely cannot afford to be stubborn or let your ego get in the way. Successful selling isn't about being right all the time. It's about being a master of risk management and knowing when to cut a losing trade. That exit plan is everything. It's your lifeline. All right, so with all those risks fresh in our minds, how do people actually do this stuff? Well, let's walk through a really popular strategy that tries to put the odds in the seller's favor right from the start. It's called a short strangle, and we're going to build it using a key concept called delta. Okay, don't let the Greek letters scare you off. For what we're doing today, delta has a really simple and practical meaning. The easiest way to think about it is as a rough probability. It's the market's best guess of the chances that an option will finish in the money, which is just a fancy way of saying it'll be profitable for the buyer. And this makes it so useful. If you look at an option and see it has a delta of 0.25, you can immediately think, okay, there's about a 25% chance this thing is going to cause me a problem, which of course also means there's a 75% chance it will expire worthless, which is exactly what we want as a seller. So here's how we actually build the trade. It's a super simple 3-step recipe. Step 1, you look for a call option somewhere above the current stock price that has that 0.25 delta we talked about, and you sell it.
Step 2, you do the same thing on the other side, looking for a put option below the current price, also with a 0.25 delta. And you sell that one too. Step 3, just make sure they both expire on the exact same day. That's it. Boom. You've just sold a short strangle.
So what's the goal here? What are we hoping for? Well, your profit zone is now this huge range between those two strike prices you sold. You've basically made a bet that the stock is going to be boring. You're betting it won't make a giant move up or a giant move down. If that stock price finishes anywhere inside your two strikes when expiration day comes, both options expire worthless and you get to keep 100% of the premium from both.
So why is this particular strategy so popular with sellers? Well, a few big reasons. First, you're playing the role of the insurance company twice, so you collect 2 premiums instead of 1, which is great. Second, you're setting yourself up with a high probability of success from the very beginning. Some studies show profitability rates can be north of 75%, and you've created this nice wide runway for the stock to trade in. It's all about playing the probabilities.
But, and I can't stress this enough, here's the trade-off. A high probability of winning is not a guarantee. It never is. That 75% chance of success comes with a 25% chance of failure. And if the stock makes a truly massive, out-of-nowhere move and blows past one of your strike prices, the losses can get big fast. This strategy is all about winning often, but you must be prepared to control your losses on those rare times you lose.
So before you even think about putting on a trade like this, let's just wrap up with 3 absolutely essential rules for survival. These come straight from the experience of traders who have been doing this for a long, long time. Rule number 1, watch your commissions. Option selling can involve a lot of small trades, and those little fees can sneak up and just eat your profits alive if you're not careful. Rule number 2, always, always respect the risk. Remember, your profit on any given trade is small and capped. Your potential loss is not. Never forget that imbalance. And rule number 3, probably the most important, know when to fold them. Just like in poker, you have to know when a hand is lost. Taking a small, planned loss is always better than praying a huge, catastrophic loss will magically turn around.
And that really brings us to the final question, the one you need to ask yourself. Option selling isn't about hitting grand slams. It's about hitting singles, consistently getting on base. It's a game of collecting small, regular profits while carefully managing the risk of that rare, large loss. So what's your style? Are you the steady insurance seller, or are you the hopeful lottery player looking for that one big ticket? Knowing the answer is the first and most important step to finding the trading strategies that are truly right for you.